to Coffee with KPP, the show that's dedicated to providing you with advice for life so that you can live richly and realize the life that you've earned. My name's Kyle Roy, financial advisor with Kentucky Planning Partners. I'm joined here with Bill Ralston, CFP and financial advisor with KPP as well. Hey, Bill.
Good morning.
Well, today we're going to be talking again about 401ks. We had a show about 2 months ago and it got really good feedback. And we're going to be going into more detail about 401k investing, things that you should be keeping in mind when it comes to your 401k. So we're going to talk about generalities, what a 401k or 403b or 457 plan looks like, some of the things to look at within your plan, i.e. employer matches and how that affects you and what that means for you. We're also going to talk about investment options, common investment choices that you have within a 403b, 401k, or 457 plan. And the goal today is looking really for anybody that's scratching their head worried or wondering how they should invest in their 401k so that you can maximize whatever investment goals you have. And lastly, we're going to talk about some options and opportunities that you might have within your plan. Bill is our in-house 401k expert at Kentucky Planning Partners. I've been in the business a long time. He manages more plans here at our firm than anybody else, so it's really a treat to have him on the show. So Bill, give us an idea. What are some generalities that the audience should know and be aware of when it comes to 401ks?
When we talk about 401ks, there's a lot of other retirement plans out there, so we might use the term 401k, but the same principles apply to, like you said, 457 plans, 403bs, simple IRAs, SEP IRAs are also employer-sponsored retirement plans that are offered through IRAs rather than 401ks. But
so what's the difference between a 401k and a 403b?
403bs are offered by charitable organizations, and they are not subject to some of the more stringent reporting requirements that 401ks are in the for-profit world.
Okay. So if you're a teacher or a government employee or a nonprofit, you work for a nonprofit, you have a 403b. But if you work for a large corporation, you have a 401k.
That's correct.
So that's important to know.
Right. And really, these plans, these corporate-sponsored retirement plans, are the best instrument for saving money and investing in the markets. There's nothing that beats it. And the reason why is because the government is paying you to save your own money. The government is offering you an investment vehicle through your employer that you can put your own money into, and it is not taxed. Any growth that you see on that from year to year is not taxed. If you had an ordinary investment account and invested in stocks, mutual funds, bonds, whatever it is, you would be getting a tax statement about this time every year saying that you have dividends of this amount and you have interest of this amount that you have to pay tax on. 401k, that doesn't happen. So you're getting a tax subsidy to save and invest your own money for your future.
That's a great way to look at it. The government is subsidizing in order to incentivize you to save for retirement. Mm-hmm. And I've never heard it that way. The government's paying you. Granted, you're not going to get a check from the government to invest in your plan, but to avoid the taxation on those contributions, mm-hmm. the government is subsidizing your investment account. That's a really good way to think about it. I never heard about it that way.
Right. And for a lot of people, their employer offers a match up to a certain level. So your employer is paying you extra money for you to save and invest your own money.
So what do you have to do to get it?
You have to do it. You have to put that money into the plan. And the third reason why it's just an extraordinary investment vehicle is because it comes right out of your paycheck. You don't have to do anything. All you have to do is sign up. It goes automatically every paycheck into that account. It gets invested. All you have to do is decide where that money is going to go once it's in there. And they give you choices. The retirement plan sponsor, the employer, is tasked with monitoring those investments, and hopefully they're working with financial advisors like us or someone else to do that. But there's really no other mechanism that allows you to build wealth in the markets the way that 401k does. You get those three benefits. You get payroll deferral, money comes right out of your paycheck. You get tax breaks. You get matching for a lot of employees. There's no other type of account out there that can give you those three things other than employer-sponsored retirement plan.
So let's unwrap the match a little bit, because I don't think most people really understand the power and the benefit of a match. So when people come in and talk to us and they invest their money, the number one objective for every investor is have their money do what?
Grow.
grow, right? And in right now with interest rates as low as they are, it's really hard to come by a predictable rate of return. Today in early 2021, the markets in certain sectors have been off the charts good. So people might say, I can earn a lot of money, but there's a lot of risk in the market as well. But if you go to the bank and try to get a CD or something like that, you're lucky if you get 1%. It's very difficult to get predictable return. So let's talk about the match. If I make, let's say, $50,000, and just to keep the math simple, my company matches 100% of my contribution up to 10% of my income. Walk me through the math and how that works and what kind of return on my investment that's going to provide me.
Well, if you're getting a match of 10%, it's a very good match, number one.
What's the average? What's the average company match, would you say?
You know, the most common one that I see is dollar for dollar up to 3% of your earnings, and then 50 cents on the dollar for the next 2%.
Okay.
So that's a complicated formula, but it's the 401k, the IRS actually puts that in place as a safe harbor match, and that's a little more in the weeds than we want to go in for purposes of this conversation. But a lot of employers adopt that because it allows them to pass their compliance testing if they're offering a match it using that formula, and some others that are out there too. You know, some are more generous than that. Certainly some companies matching isn't that generous. Not all companies can afford to do a match, but if you're fortunate enough to have a match, most employees do. It's really worth your while to understand what your match is and make sure you're getting the full amount of the match, not just the dollar for dollar for 3%, but keep going, keep getting that extra 0.5% on the next 2% and go beyond there. And really, I tell people, you know, I often get the question, how much should I be saving in my 401k? And 10 to 15% is the answer. If you're, for the majority of your working years, from the time you're in your 20s up until your retirement age, if you're putting in at least 10% per year in your 401k, there's not many scenarios where you're not retiring comfortably. There just isn't. It's historically speaking, you know, if you manage the account well, don't take too much risk, especially in the later years. It's worth taking risk in the early years, but not so much in those pre-retirement years. You know, but you're saving at that rate, plus getting a match on top of that. There's almost no way that you're not going to be well off.
Yeah, and when it comes to that match, you know, and so let's say an example is, and to Bill's point, put away as much as you can. You're never going to regret saving too much for your future, because especially the older you get, you'll realize how quickly the future comes. And with a match, if you're worried about return, and say you put in $5,000 in a year into your 401k, and if that is the amount up to which your employer will match, that means for the $5,000 you put in, your employer is going to put in another $5,000 into your plan. And if you put in $5,000 and you immediately get another $5,000, what's the return on your investment?
100%.
100% just by making the investment, right? So not only is it easy to kind of wrap this point up, not only is it easy because your 401k contributions come out of payroll deductions, it's automated. You're not going to miss it as much because you probably won't even realize it by the time you get your paycheck. The government incentivizes you to do it because they subsidize it by not taxing it. And with a company match, you are, for every dollar you're putting in up to that match, guaranteed 100% return on that portion because you're getting the equivalent dollar lumped in. You're not guaranteed that return on the markets, of course, but if you put in $1 and your company matches $1, that's an immediate double of your investment. Okay? So now let's move on to what you're actually invested in. So let's talk about some of the most popular and common investment options we see in 401ks.
Sure. It's almost always mutual funds are an option for you inside the plan. So if you work for a larger company that's publicly traded, you might have company stock available to you inside the plan as well to invest in. Companies like UPS here locally, you see a lot of UPS stock and for employees who work there in their plans. Sometimes there's exchange traded funds and plans. That's less frequent, but it's becoming more and more popular for companies to do that. But it's always a menu of pre-selected investments that the employer is tasked to monitor, again, usually with the advice of an advisor at some level. The investments inside the plan to make sure they're of decent quality. You usually get a mixture of mutual funds and investment stocks, mutual funds that invest in bonds, or some combination thereof. And there's usually a fixed or a money market account in there as well.
Mm-hmm. And money market is another fancy term for pretty much cash. It's a cash equivalent. So you're not going to see a money market account grow nor lose much on average, right? I've never seen a money market account do.
Well, right now, most of them are losing money because all 401k plans have some level of expenses associated with them. There's a lot of reporting that's done by the financial institution that holds the 401k on the behalf of each participant. And there are different service providers on the back end of your 401k plan that have to get paid one way or another. So all plans have a certain level of expenses associated with them. Sometimes they're hard to find because they're in the fine print, but they're there. And if you're invested right now with interest rates being so low in a money market option inside of a 401k, you're probably losing money because you're probably not getting enough interest on that cash in the account to make up for the expenses that are coming out. So you might not notice that because you're contributing money from your payroll every pay period into it. But chances are, if you're any portion of your 401ks in the money market right now, it's probably not a good spot for it.
Now, and there are situations where money market makes sense. So the question would be, if I were watching this, well, why would they have it in my 401k? It's pretty much guaranteed to lose money. Well, it's not always going to lose money. If interest rates come back, it will probably earn something. But where that money market would probably make most sense is if you're nearing retirement or if you're nearing a situation where you're going to need distributions from it and you just wouldn't be able to afford a sudden drop in the market. So the closer you are to actually needing to spend those dollars, which in your 401k, hopefully it's not for a long time or until you retire, right? But that would probably be the only place you do it. A lot of people may have gone out of the market, tried to time it and got a money market last March or April when it was down. They never got back in. And we see a lot of that and people trying to time the market themselves. And it's the old adage, it's not timing the market that will boost your returns most often. It's time in the market. So keeping an investment portfolio, staying the course, making sure if you're 20 years out for retirement, those short-term movements, if you're not doing on a systematic basis, is probably going to hurt you more than anything in the long run. Right. So let's talk about target date funds. What are target date funds? Most plans have those, and what should people be thinking about there?
So target date funds are usually listed as an option in the retirement plan. They're not in every plan, but they're in probably 90 to 95% of the retirement plans out there these days. You'll see them listed usually in increments, usually the 2020 fund, the 2025 fund, the 2030 fund. And they are managed to be by the investment team behind them to be risk appropriate for someone in an age group that's going to be retiring around that year. It's listed in the target date fund. So if you are someone who's age 60 right now, you plan to retire in your mid-60s, 2025 fund is probably a good fund for you. And in fact, some plans will even default you into that investment if you haven't made a choice otherwise to be in something different. So they're a really good option, Kyle, for most people. If you consider yourself to be the average investor for someone your age, you're not looking to be overly aggressive, you're not looking to be overly conservative, you just want to be in a good, balanced, diversified portfolio that's risk appropriate for someone in your age group, target date fund is a great option.
Yeah, and now you're absolutely right. It's a phenomenal tool to help. You use the word average investor. I would say it's a great tool for the average working American, right? Because the average working American probably doesn't consider themselves an investor. So it's one of those things where if you really don't understand how you're an investor, why you're an investor, know anything about investing in the first place, but you're 30 years old and you're 35 years away from retirement, that 2055 target date fund is the 2055 would be the date around which you're going to retire. Is probably a great option for you. It's a whole lot better than doing nothing. So you can get the match, so you can be invested somehow, now, but
you don't have to worry about is this the time I should go to cash?
That's right.
Yeah, the target date fund, the managers are taking care of that in there. They're usually not going to cash is the answer, but they gradually get more conservative as you approach that target age. You start off aggressive if you're a younger person, you're the 2040 fund, the 2045 fund, the 2060 fund. I'm seeing those a lot these days in retirement plans. Those are going to be aggressive funds because there's a lot of time that you have to ride the ups and downs of the market and take advantage of the highs that the market gets. But they get gradually more conservative over time, and so you don't have to worry about trying to time the market and when's the best time to be conservative versus based on what the market's doing today or this month or whatever.
Now, there are some shortcut falls to the target date funds as well. So, and we'll talk about that in a moment. But first, I want to address a common pitfall that I think we see often, and that there are investors, clients that come to us or prospects that come to us want to sit down, and they may have had an experience with a financial advisor that was asking them to get their login or username to their 401k account. It's common for somebody to say, hey, Kyle, would you mind just telling me what to invest in my 401k? Now, what we're going to talk about briefly, a little tangent, are the federal rules. It's called ERISA. ERISA rules are strict in that they prohibit financial advisors from giving advice on retirement plans that they don't manage. So, granted, we'll be able to give general information if you have certain funds in your 401k. We'll be glad to tell you how they work generally and maybe give you some guidance, but let's talk about that. Like, what are the rules regarding ERISA and the ability to manage somebody's 401k? And we want to make sure that you have red flags go up. If anybody's saying, oh, just give me your username and password, it might seem commonsensical to do that. But if you have a professional looking financial advisor that seems to know what they're doing, just don't give your username and password. It's literally against the law. It's breaking federal law.
Yeah, it's technically it's fraud. So you mentioned ERISA. That's the Employee Retirement Income and Securities Act, 1976, 1978. I don't know the exact year. But to be clear, it doesn't strictly prohibit a financial advisor from giving you advice in your plan, but it makes them a fiduciary when they do so.
Thank you.
And different firms have different rules about what fiduciary liability they're able to take on for themselves when they're advising someone in a retirement plan that their firm is not attached to. So essentially, it's when you reach a certain point, what's called the retirement red zone. Some companies call it that, right? Where you're probably 10 years from retirement, 5 years from retirement. You get to that point where you really can't afford to mess up. Maybe you've been investing, you've been putting this money away for a long time. You have a nice balance at this point in your life, and you're going to be living off that balance pretty soon. So that's the point where you really want to make sure you're engaging with an advisor, unless you're otherwise, for some other reason, 100% confident that you're going to retire securely. To make sure that things just don't get messed up. The target date funds are a good tool for the average investor. But once you get to that point where, okay, I need to make a plan on how I'm going to start taking this income and how I'm going to make this last for my entire lifetime, do I need to be invested a little more aggressively than what I am currently just to make sure that money lasts, in an intelligent way with an advisor? Or maybe, I'm planning to live pretty prudently in retirement. I don't plan to take elaborate trips. I want to just be conservative and be able to sleep at night. That's the reason why you might want to get out a target date fund and seek the help of an advisor to make sure that the portfolio matches your goals, matches your concerns. And that's where we can do that. Just because you might be in a retirement plan that we're not attached to doesn't mean we can't give you advice on it. But it does mean that we can't go in and use your password and go into your website and make changes for you. We cannot do that.
That's right.
But we can give you general advice on what funds you should be in. And there's other tools too that we can do to help clients manage their money in their retirement plans while they're still working.
So let's talk about it. A great segue. So one of the opportunities that's out there is, as great as these target date funds are and things like that, one of the issues that we find is that they're not customized to each individual, right? So the level of customization isn't there with target date funds. If you're 50 years old, 15 years out for retirement, yeah, you might look at a 2035 target date fund. But you are an individual, unique and different from the person that sits next to you at work or is on the line or whomever that you might be working with. And you might require some individualization into your portfolio just like you live your life. So one of the opportunities that's recently become available to us at Kentucky Planning Partners is the ability for certain companies to actually become your financial advisor on your 401k plan through what's called a self-directed brokerage option. So we're not going to go into too much detail on it, but if you're wondering about your 401k and you're wondering about your options that you have, is your asset allocation aligned with your goal, and are your investments aligned with your overall objective? Well, give us a call, come in and sit down with us, and we'd be glad to make sure that every dime you've saved and every dime that you've earned is working toward that life that you envision for yourself. And for certain large employers, especially all over the country, we have the ability to actually open up your investment allocation and your investment options and be able to work with you and help pull certain levers if need be, and help build a comprehensive financial plan actually customized to you. So if you're 50 years old, for instance, and maybe you have plenty of savings outside your 401k, a target date fund may not be appropriate because you might be more risk adverse. You might be able to take on more volatility and understand that and afford to do that. Others might have accomplished their goal, their savings goal, and they don't need to take on nearly as much risk as the average 50-year-old would. So to be able to have that flexibility, specifically with KPP, it's not a unique opportunity to KPP, but the majority of financial advisors don't have this opportunity to go in through that self-directed brokerage option and help you manage your 401k with the proactivity and individuality that you'd expect.
Mm-hmm. Yeah, it's a really nice option when it's available. So come talk to us about it.
That's right. So do you have anything else that you'd like, generalities that you'd like to talk about that you think people miss? What do you see as the most common pitfall? And it might be what we've already talked about too.
It's being in cash in your 401k. There's not many circumstances where it's appropriate to be in cash in your 401k. If your retirement goal is to go out and buy a house in Florida with your 401k money as soon as you retire, and you're retiring next year, sure, go ahead and put that money in cash because you're going to go spend it all the day you retire. And that's fine. If you have other assets you're going to live on at that time, great.
They have a tax bill too.
Yeah, it
that
certainly
house would cost a
will.
lot more than what you actually paid for it.
Yeah. So that's another good point. But there's not many other circumstances that come to mind for me that I've seen where it's appropriate to be in cash inside the 401k. There's plenty of conservative investments inside most 401k plans that will should give you over a complete market cycle some level of return above cash. So in a fairly predictable way. So that's the biggest mistake I see most often. Another big mistake that you see with 401k investors is just not putting enough money away. They're putting enough in to get the match. They're putting in the 3%. They're putting in the 5%. I'm getting the match. That's as much as I can put in. It's not true. The most that you can put in from an IRS standpoint is $19,500 per year if you are below age 50. If you are over age 50, you can put in $26,000 out of your paycheck into the 401k every year, and that's before your employer puts in any money, any matching, any profit sharing that they might do on their behalf. So don't think that you're limited. Some plans can be limited if they're considered top heavy, but again, that's a conversation that's a little more in the weeds that we want to get into. But for most people, it's that flat dollar amount that is the max you can put in. So don't think that just because you're putting in the most to get the max that you're putting in enough.
Mm-hmm. Yeah, no, and a friend of mine just reminded me that once you put it in there, your money is yours. It's your money for as long as you live. So that company match, if you're not doing it, you're literally leaving your money on the table. Mm-hmm. So with every other dollar that you earn at work, you have to work really hard for it. Whereas with your company match, you just need to sign up.
That's right.
You need to sign up and save for your retirement. You need to hold yourself accountable and check a box on an online application to begin saving for retirement. And for those of you just starting your career, if you have children that are just starting out, I can't encourage you enough to have your children begin investing in their 401k as quickly as possible. Oh, yeah. When we were in grade school, there was the old mathematical problem. What would you rather have? Somebody give you $1 million today, or give you a penny today, and over the course of a month, double that penny every day, and at the end of 30 days, how much would you have? Well, when you're in sixth grade, everybody takes the $1,000,000, but the power of compounding and the doubling of that penny turns out to be an incredible amount by the time you get to the 30th day. And that's an extreme example, but a powerful one about the importance of compounded interest and saving as early and as often as possible. And to Bill's point, put as much away as possible. Do it, because the future comes quickly.
It's the best tool that you have for getting rich slowly. People think about putting money in the markets, getting rich quickly. No, 401k is about getting rich slowly, but with some level of certainty. I mean, it's in the markets do go up and down, but you can manage that volatility over time. If you're putting the proper amount of money away every year, plus getting a match on top of that, you're setting yourself up to build significant wealth for yourself in your retirement years. Get rich slowly.
I love it. So with that said, thank you. Thank you for joining our conversation today. And please share this with anybody that you know that has questions about their financial future. If they're worried about their ability to save, we know that it can be challenging at times, but all you got to do is check that box. And to Bill's point, you're not going to miss the savings, but you'll be so grateful and thankful for yourself, and your family members will be able to spend the time with you as you age and you get to realize that life that you've earned. So if you have questions about this, if you have questions about your 401k, give us a call at KPP. Our phone number is 502-394-0400. We're located on the top floor of the Flash Q building on the corner of Hurstbourne and Shelbyville Lane in the heart of Louisville's East Side. Our goal, our vision at KPP is to make sure we're providing advice for life so that you can live your life, so that you can live richly and realize that life that you've earned. So we're here to help you. We're glad to help you. Thank you for listening. We hope you have a great day and look forward to talking to you soon.